All right, if you're holding your W-2 right now, getting ready to file your 2025 tax return, I want you to take a good long look at it. Seriously. Because that document and the rules that come with it, they're basically an endangered species. You see, this tax season, the one we're in right now in early 2026, is what everyone's calling the pivot year. The return you're filing is for 2025, which is great news, because you still get to play by the rules we've all gotten used to. You know, the lower tax brackets, that massive standard deduction. But here's the catch. This is the final, guaranteed year of this tax code. Everything, and I mean everything, is on the table to change.
This right here is the date. Circle it on your calendar, set a million reminders on your phone, whatever you got to do. December 31st of this year, 2026. Because at the stroke of midnight, the current tax code as we know it is set to expire. And look, this isn't some hypothetical. It's not a maybe. It's written right into the law. Unless Congress gets its act together, and we all know how that goes, the entire system is scheduled to hit a giant reset button.
Okay, let's break this timeline down, because it's the key to everything. The law we're talking about is the Tax Cuts and Jobs Act, or TCJA, from back in 2017. The return you're filing right now for 2025. It's all TCJA rules, which have been pretty good for a lot of people. But here we are in 2026, the pivot year. This is your last best chance to look ahead and make some smart moves while you know exactly what the rules of the game are. Because in 2027, we hit the cliff. The TCJA provisions just sunset, they end. Tax rates, deductions, credits, they're all set to snap back to the old and often much higher levels. So the moves you make today, they're about way more than your refund check. They're about protecting your wallet before the ground shifts right under our feet.
So in this explainer, we're building your playbook. We'll kick things off with the big warning for this tax year. Then, we're going to decode the secret language on your W-2 that tells the IRS what you're up to. I'll show you why the standard deduction is so huge right now, and why it's probably your best friend. We'll tackle that 2027 tax cliff head-on and map out a survival guide. We'll hunt down the family credits you absolutely cannot afford to miss. And finally, we'll put together your action plan for the rest of 2026.
So here's the bottom line. The tax return you are filing right now for 2025 is your final chance to operate under this guaranteed set of rules. Every single decision, from how much you put in your 401k to whether you sell a stock, carries so much more weight this year. It's your last shot to use the system you know before it all gets thrown up in the air, so let's make it count.
All right, let's dive into the most important tax document you'll get all year. Go ahead and grab your W-2. No, seriously, if you have it nearby, pull it out. The number one rule of tax strategy is to stop obsessing over that little estimated refund number in your software. That's for amateurs. The real story, the clues to your future tax bill, are hiding in plain sight in those boxes on the top left, and we're going to decode them right now.
All right, first things first, find box 1 on your W-2. It's labeled Wages, Tips, Other Compensation. Got it? Okay, now find box 3, Social Security Wages. Just take a close look at those two numbers. Are they different? For a lot of people, they are. Is your box 1 number lower than your box 3 number? The answer to that question tells you everything about your tax strategy last year. So if the number in box 1 is lower than box 3, you should give yourself a little pat on the back. You're winning. Here's why. Box 3 is basically your gross pay, what you actually earned. But box 1, that's the number the IRS gets to tax for federal income tax. That gap between them, that is what I call your wealth shield. It's all the money you successfully hid from the taxman using pre-tax contributions. We're talking about your traditional 401k, your health savings account, and even your health insurance premiums. The bigger that gap, the stronger your shield. If those numbers are the same, well, it just means you're paying tax on every single dollar.
Now for my favorite part. Let's find box 12. I call this the snitch box. Why? Because this is where your employer spills all the beans to the IRS about your benefits. It's the little informational box that tells them exactly what kind of financial moves you've been making. You'll see these little codes with dollar amounts next to them, and each one tells a story.
Let's pull out our decoder ring. If you see code D, that's your traditional 401k money. That's the pre-tax stuff that helped build your wealth shield. Now, if you see code AA, that's for a Roth 401k. That's different. You already paid tax on that money, but the upside is it grows totally tax-free. Then there's code W. This is for your health savings account, or HSA. And if you have this, you are using maybe the single best savings tool out there. It's a triple threat: tax-free in, tax-free growth, and tax-free out for medical bills. If your box 12 is empty, you are leaving major tax breaks on the table.
And that brings us to the code that freaks everyone out. Code DD. You might see a huge number here, 10, 15, 20,000 bucks, and your heart just stops. Relax. Let me say it again. This is not taxable income. This is just your employer telling the IRS how much your health plan cost. So what should you do with this number? Add it to your salary in box 1. That amount, that's your real total compensation. It's the hidden paycheck that most of us forget about when we think about how much we make. It's a massive, tax-free benefit. Okay, so you've put all your W-2 info into your tax software. Now you come to a big fork in the road. Do you itemize all your little deductions, or do you just take the standard deduction? For the 2025 tax year, the standard deduction has gotten so big that for most of us, this decision is easier than ever.
You can think of it like this. Itemizing is the hard way. It means you got to keep every receipt, track every donation, and prove every single expense. Your mortgage interest, your charitable giving, your state taxes. It's a whole thing. The standard deduction, though, is the easy way. It's just a giant fixed amount the IRS lets you subtract from your income, no questions asked. The TCJA basically doubled this number, and it made filing taxes way simpler for millions of people.
And for 2025, that easy way amount is absolutely massive. If you're married and filing a joint return, the standard deduction is $31,500. I want that number to sink in for a second. It means the first $31,500 you earned last year is completely invisible to the federal government. Poof, gone. You owe zero federal income tax on it.
And hey, if you're a single filer, you're not getting left out. Your standard deduction is a huge $15,750. Again, that's a giant chunk of your income that you just don't have to pay tax on. It's one of the biggest tax breaks out there, and you get it just for checking a box.
Now, I can already hear some of you shouting at the screen, especially if you live in high-tax states like New York, New Jersey, or California. But wait, my property taxes and state income taxes are huge. I have to itemize. And this, my friends, is where we hit one of the trickiest parts of the current law, something called the SALT trap.
And this table just lays it all out. The deduction for state and local taxes, that's your property taxes plus your state income or sales tax, is capped. It's capped at just $10,000 a year. That's it. So even if you paid 20 grand in state and local taxes, you can only deduct 10,000 of it. So when you put that $10,000 cap up against the $31,500 standard deduction for a married couple, well, the math isn't even close. The standard deduction wins, hands down, for most people.
All right, let's pivot to the future. We've optimized the tax return you're filing right now, but the real big brain move is preparing for what's coming, that 2027 tax cliff. We're not just talking about rates going up a little. For a lot of people, it could feel like getting hit with a 9% penalty just for going to work in 2027. You see, right now, under the rules for 2025 and 2026, we are sitting in a tax bracket sweet spot. The 24% bracket in particular is just enormous. If you're married and filing jointly, it covers income from around $95,000 all the way up to almost $400,000. Just think about that. It's a historically low rate for such a high level of income.
But here's the cliff. If the law expires, that big, comfy 24% tax bracket, it just vanishes, and the old system snaps right back. An income that was taxed at 24% in 2026 could suddenly be taxed at a marginal rate of 33% in 2027. That is a 9-point jump. It's a huge penalty for earning the exact same amount of money just 1 year later. Your tax bill could shoot up by thousands.
So what's the move? One of the most powerful plays on the board is a Roth conversion. If you've got money in a traditional pre-tax IRA or 401k, you can choose to convert it to a Roth. Now, you do have to pay income tax on the amount you convert, but the strategy is to do it now, in 2025 or 2026, while you're in that 24% sweet spot. It's like paying a highway toll today for a 24% price instead of being forced to pay it in a few years when the price jumps to 33%. You're locking in the lower rate on that money for good.
Okay, for all the parents and caregivers out there, let's talk about getting your money. We've talked about deductions, which are good, they lower your income. But credits? Credits are way better. A credit is a dollar-for-dollar reduction of your tax bill. And for families, these credits can feel like a kid bonus that puts real cash right back in your pocket.
For tax year 2025, the child tax credit is still at that enhanced level of $2,000 for every kid you have under the age of 17. So if you've got 2 kids, that's a $4,000 credit that just wipes out your tax bill. It's one of the biggest credits there is. But the real magic is what comes next.
I want you to focus on this number, $1,700. This is the refundable part of the credit. And what does refundable mean? It's exactly what it sounds like.
It means even if your tax bill is zero, even if you owe nothing, the IRS will still send you a check for up to $1,700 per child. This isn't just a tax saving. This is cold, hard cash back in your bank account.
And now for a little hack that so many people miss, especially folks in the sandwich generation. You're supporting your kids, but also maybe helping out your aging parents. There's another credit for dependents who don't qualify for that main $2,000 one.
It's called the Credit for Other Dependents, and it's worth $500. This is for your college kids who are over 17, but you still support, usually from 19 to 23. But it also applies to an elderly parent or another relative that you're providing more than half of their support for. It's so easy to forget, but $500 is $500. Do not leave this money on the table.
Okay, we've talked a lot about the past, your 2025 return. Let's talk about the present and the future. We are living in 2026 right now. The moves you make today, tomorrow, this week, they will set you up for that 2027 cliff. The IRS has already announced the new retirement contribution limits for this year, and you need to act on them, like now.
Go ahead and take a screenshot of this. For 2026, the max you can put in your 401k is up to $24,500. If you're 50 or over, you can throw in another $8,000 for a massive total of $32,500. The IRA limit is up to $7,500. Here's your homework for tomorrow morning. Log into your HR portal at work, find your 401k contribution, and just bump it up, even by just 1%.
Look, you probably won't even feel an extra $50 or $100 missing from your paycheck, but the power of automating that increase is huge. By just setting it and forgetting it, you'll have effortlessly sheltered thousands more dollars from taxes by the end of this year. So do it for future you. Because if tax rates do jump in 2027, you are absolutely going to wish you had built a bigger wealth shield and stashed more money away back in 2026 when the getting was this good.
So let's wrap this all up. Your 2025 tax return is your last dance in this low-tax environment. Your checklist is simple. 1. For most of you, taking that huge $31,500 standard deduction is a no-brainer. 2. Actually understand your W-2. Find your wealth shield. See what your Box 12 codes are telling you. 3. Think about moves like a Roth conversion to take advantage of that giant 24% tax bracket while you can. And 4, and this is the most important, log in and bump up your 2026 retirement contributions today.
The rules of the game are on the verge of a major change. This whole period of historically low taxes is set to expire. But for this year, for this one crucial, pivotal year, you have the advantage. You know what's coming. You now have the playbook for the end of this era. The only question left is, how are you going to use it? All right.